Just a little tiny bit of background. We are part of UBS Asset Management. I think most of you are familiar with UBS as a name, but UBS Asset Management, as opposed to UBS Wealth Management and UBS Investment Bank. So we're all part of one group, but we sit within the asset management arm. And specifically, the ETF offering sits within the passive offering within UBS Asset Management. So what I'm not going to talk to you today about is directions of the markets. I have absolutely no view on the market. I have no view on currencies or anything like that. I'm going to talk about tools in your toolbox via ETFs and how to get exposure to various types of things. I think a little bit of background about the ETF market is not a bad thing to talk about. I think everyone now is at least familiar with the name, the concept, what an ETF is, the staggering growth that we've seen over the years. Just to, so you can see this figure, and that should say trillion, but you can see, well, billion, but 2.4 trillion sterling in total assets in ETFs globally, which is a staggering figure, and staggering in the context of where things stood 10 years ago. Clearly, the US is the market where most ETFs are, but Europe is growing, and other markets, including Japan, are growing very well as well. Asset classes, no surprise that equities are the largest, but I think it's fair to say that fixed income, for many years, the case was, oh, no, you can't be touching fixed income with ETFs. You really need an active manager. And that is certainly changing as well. So we would expect to see this as a proportion to be rising going forward. Again, we're probably familiar as to why ETFs are attractive by now, but I'll give you a quick summary, just for a little bit of a refresher or for people who aren't that familiar. Of course, they have the benefits of mutual funds wrapped with a single stock. I think if we went back in time, if you were going to create a fund house 20 years ago, or if funds were created 50 years ago, I think an ETF structure would be how one would want to do it. Why would you not want to see it traded on exchange and be able to watch what it's doing on your iPhone through the day? So I think in that respect, I just don't see how ETFs are going to do anything except keep growing and might eventually envelop other types of what traditional fund structures would be. But liquidity, flexibility, I don't have time for the sake, again, the amount of minutes that we've got here to go through all of this, but I think just to really touch on the cost effectiveness, I think there's in many cases, an ETF can offer you an exposure for 10, 15, 20 basis points, sometimes 40 basis points, where an active alternative could be 60, 70, 80 basis points. Now, I'm not taking anything away from active managers. I really, just to say, I own active funds in my pension. I used to be an equity broker with HSBC. I believe in active as well, but there's many cases where if you don't have high conviction, if you don't believe the manager can create alchemy or has some secret sauce, then ETFs are a fantastic alternative to use. I think the S&P 500 is a famous case where most people are saying, well, look, you cannot beat the index after cost, so I'm just going to wave the white flag. I'm not going to bother trying to pay an active manager. I'm going to go passive. We all know what Warren Buffett said about what he'd recommend his wife investing in, S&P 500 passive. So just to, again, it's really about having high conviction. If you think an active manager can do, add value, fantastic. But otherwise, ETFs and passive generally is a very interesting option. Just the last point on this, investor protection is very important as well. Just to clarify, an ETF is a fund, as in the name. It's a UCITS fund. All ETF providers operating, trading with ETFs on the LSE, again, these are funds. They have UCITS protection. It means that even if UBS or any other provider went under, you as an investor are protected due to the fact of that UCITS structure. Even if we went under as UBS, you as the beneficial owner of the ETF, those assets are owned and ring-fenced by the fund, and ultimately, therefore, you are protected. That is not the case with an exchange-traded note or an exchange-traded commodity. You can have a commodity ETF, which is distinct from an ETC, but just to be aware, those are ultimately debt securities issued by an investment bank. I'm not trying to create any scare stories. I just think people need to be aware of the distinction between an actual bona fide ETF and other products which sound a bit similar. I think a last point I just should mention, I kind of alluded to it before, but increasingly I think ETFs are so attractive to people because I mean, we're leading up to Christmas. A lot more people are buying presents online. You want to know exactly where the delivery is coming. I'm going to check on my app and see exactly where the delivery van is. We now have Uber. You can see where the car is coming. Everybody wants almost immediacy in this transparency. And again, trading on exchange throughout the day means that you can see exactly what the value of your ETF is throughout the day. That's not the case with a standard mutual fund. And I think for a lot of investors, increasingly, this is a major attraction. Being able to see that on your iPhone. But just jumping ahead quickly about UBS, I was kind of intending to spend about 5 minutes on 3 topics. So just say that currency hedged ETFs, socially responsible ETFs, and also smart beta ETFs. A little background about UBS. I mentioned about the group, but we are the 4th largest ETF provider in Europe. We have a lot of specialist areas. We have a lot of major growth in our core exposures. But we have seen very strong growth over the last 7 or 8 years or so. And we continue to see strong growth coming through, although this year not as strong as last year. I think this is probably the most important point to mention here. We have over 200 ETFs, but we have about 99 listings on the LSE, which is obviously where most of you would want to be accessing these products. So, as I mentioned, the title of this presentation was "It's not just plain vanilla any longer." And the idea behind that is that, of course, there's huge growth coming through in ETFs tracking the standard indices, S&P 500, the FTSE 100, MSCI, emerging markets, that type of thing. But we have seen huge amounts of growth in these more off-piece or esoteric types of exposures in the last couple of years. And one of the 3 of these is ETFs with embedded currency hedging. Now, I hope that doesn't sound a bit scary for some of you to understand, but it's worth just pointing out. When you invest abroad, you are implicitly taking 2 bets. One is on that equity or fixed income market that you're investing in, but you always then also have to consider the currency. You cannot invest in Japan without taking ultimately 2 bets implicitly. Of course, as I mentioned, I'm not going to tell you anything about predicting currency markets because I have no idea, as most people probably don't. It's virtually impossible. Having said that, increasingly there's ways to do something about this currency uncertainty, totally neutralizing it or potentially taking a bet on where you think that's going. So let me just let you digest that chart. It's a little bit of a dog's dinner a little bit, but I'll let you have a quick look at that before I talk. So I mentioned about currency fluctuations potentially having a big impact on your investment. Now, just to talk you through this quickly, the dark blue line, if you see the dark blue and light blue lines, they're on top of each other. Now, just ignore the light blue line for a second. Just look at the dark blue line underneath. I mean, same line, but what we're talking about is this. This is the European Monetary Union, so the Eurozone equity market, so everyone who uses the euro, the equity market, through a period, I just used a snapshot here to make the point, between the beginning of 2013 to the beginning of 2015. So a 2-year period. Now, through that time period, look at the dark blue line underneath, a French or German investor would have made almost 20% per annum over that time period. That's fantastic for them. However, a British investor through that same time period made merely 11.7%, due to the fact over this time period, the euro was tanking against sterling whilst you were invested, assuming this was you. So the interesting point to mention is that whilst the French or German investor was riding up here, your money was being eroded away at the decline of the euro whilst you were invested. And accordingly, this is the British person's returns, as I showed here. This shows you the detachment of the British return, the British person's return versus a French person's return, assuming you're based out of in sterling here in the UK. And again, there's the currency. Now, the important point about embedded currency hedging is that it totally mitigates this effect of the currency. This is the actual return that the British investor would have gotten if they invested in the European Monetary Union Index with embedded GBP hedging. So you can see you're basically getting identical performance pretty much. In fact, in this case, it's slightly better due to the way the hedging is done. We don't have time to go into that now, but I think the very important thing I need to mention, this is not some free lunch. remember, this can go both directions. It's a double-edged sword, but I need to just highlight, I think this is a very good example of the benefits of currency hedging. But remember, if the euro had done this instead of that, you would have foregone the upside that the euro appreciation would have delivered you through that time period. So again, I want to make it very clear, as your retail investors, this is not a one-way free lunch type of thing. It goes both sides, but if you believe you simply want to mitigate the effect of these currency fluctuations, I mentioned before, I think everyone agrees they're almost impossible to predict. I mean, Russ, who knows, right? Currencies, notoriously difficult to predict. If you simply want to mitigate the effect, you can buy these funds with embedded currency hedging. So, just to jump ahead quickly, we're the largest provider in Europe with 42. In terms of assets, we're at the moment slightly lower than iShares, excuse me. But we have, like I said, the widest array of products in that. There is a product overview, which you can pick up in the back to have a look at that. Quick summary. Again, I'm conscious of time, and I have two more little subtopics to go through. So, sustainable investing is something which, I have to be honest, 3 years ago when we launched these products, these ETFs which track these MSCI sustainable indices, we really didn't have much interest. So it was a very specialized group of people who were interested. In the last 15 months, we've seen assets triple. Like I said, in 15 months or so. We've just reached $1 billion in assets under management in these products. And I think it's fair to say that there's a lot more people now aware of the fact that these are out there, because previously you'd have to go active or do your own stock picking, avoiding the BATs, the imperial tobaccos, the BAE systems, all the traditional sin stocks. But now there are cheap, easy to access, transparent ETFs which can give you exposure to that. Now, I mentioned about a dog's dinner before. I think this chart's probably even more hard to get your head around than the previous one. But it's something that, again, you'll have a slide pack at the end that you can have a look at this. Historically, it would have just been this part, this negative screening, as we call it. But the underlying indices which we use, which are developed by MSCI in conjunction with their various clients, such as ourselves, it's a two-step process. You have the negative screening, which you're looking at the parent index. You're basically removing about 10% of the stocks on this basis. But then the next stage, you've got these two parts here. You're then basically getting the parent index down to about 25% of the constituents. So again, you're getting rid of the sin stocks, but then you're trying to pull together the companies with the best environmental, social, and governance policies or practices. So they have a whole team of analysts, about 240 analysts, that all they do are look at companies and look at their ESG profiles, how well they're handling things like water stress, carbon emissions, corporate diversity on their boards, all sorts of things. Again, you can see there's 37 different ESG issues that they look at. In addition to that, again, we don't want to go into too much detail here. This is the controversy score aspect. You could have a company with a very good ESG, this IVA ESG score. But at the same time, you could have had like a BP, let's say Volkswagen, were not too bad on this, right? But then they had a massive scandal going on. So a massive red flag comes out, and they would therefore be precluded from being included in the index. As it happens, Volkswagen were not in this SRI index. If they had been, they would have been, at the next quarterly review, they would have been ejected from that index. Now, again, we don't have time to go through this in full detail, but I think the important point to stress is that these products are out there. You no longer have to pay an active manager to do this or necessarily do your own stock picking to get these types of exposures. And I guess you could say sleep well at night knowing you have a good conscience in your head about this specific point. Now, I'll show you one. I'm going to jump ahead one slide to this, which is, I think this is very interesting because this will raise some eyebrows. I think most people here would assume if you're going to invest ethically, you've got to pay the price in terms of performance, right? You're going to, if I'm going to invest like a good guy, then, I'm going to have to underperform a little bit or pay a bit through the nose for the product. If you have a good look at this is the performance of these different indices which our ETFs track. MSCI World Index, USA, European Monetary Union again, Japan, et cetera, UK. This is the extended UK index. In each case, with the exception of the USA, in each case, the SRI index has outperformed the parent index, which is extraordinary, really. And now, have a look at these dates. Some of you, so wait a second here. You're fiddling about with the dates on these. But these are the inception dates of the indices. This is just when MSCI developed these indices. So the extraordinary thing is that, again, I was certainly surprised when I first saw this. I was very surprised to see the performance. But the world SRI, USA is an exception, I'll explain in a second, but look at the European Monetary Union, the per annum performance. And this number in here is the Sharpe ratio. So basically, your risk-reward profile is more attractive in the SRI indices than the parent index. The case of the US is kind of exceptional. I'll just explain quickly. Long story short, Apple, Google, or Alphabet as it's known now, Netflix, Amazon, and Facebook all did not make the all-star team of the SRI index. Doesn't mean they were sin stocks, they just didn't quite make that top 25%. So if you didn't have Apple and those other stocks, well, you know, and the methodology is the methodology. They're not going to make an exception. We will let Apple in there, shall we? Because they're such a great performer. You know, but I think it's a firm methodology, and it's interesting because over this extended time period, it has delivered superior results. Again, little caveat, I can absolutely not promise you that will be the case in the future, but I think this is certainly an eyebrow raiser. So just to go back quickly, that shows where we stand in terms of the market share. We're the leader in Europe in SRI ETFs, 45% market share. I mentioned already that our assets had tripled in 15 months in this space. So it's getting so much more interest than it had been from wealth management clients, charities that are behind this, but also various just regular investors who say, well, I just want a global exposure. I just want it with an SRI screen. And these things are not behaving completely differently than the parent index. It's not like the parent's doing this and this is doing this and vice versa. They're very tightly correlated, but again, you're screening out the sin stocks as well as the ones that have less impressive ESG profiles. So with 3 minutes to go, I might run over by 1 minute if that's okay. 2 minutes maybe. So the last topic was, I guess by now also everyone has heard of smart beta. There's a lot of noise in the market about this, about smart beta this, smart beta that. We prefer to call this alternative beta. The academics call it factor investing, and there's about 50 years of academic research which has gone into this. Now, again, slightly difficult chart or slide to get your head around it immediately, but just to remind us of beta, or beta as Americans would call it. Beta is passive investing where all we're trying to do is match the index. If the index goes down 50%, we want to go down 50% as well. Not very nice, but that's the idea. Active, as you know, or alpha is all about active, trying to beat the index. Alternative beta or smart beta kind of sits in here. You're still tracking an index, but it's a kind of it's a specialized screened index. What we specifically look at are these 4 different factors. So value, we all know what value stocks are. Quality is about, well, I'll go in the next slide, explain this to you. Yield, we know, and low volatility. So companies which are kind of boring, steady, don't fluctuate as much as the rest of the market. Again, for the sake of time, but I think this is a good little summary, which you can have a look at afterwards in your slide pack. But why, value companies, we all know low price to earnings, low price to book stocks, steady companies, but not junky ones. They're not cheap because they're junky. These are good quality companies, but are cheap on these key valuation metrics. Low volatility, like I mentioned before already, quality is about, strong return on equity, solid balance sheets, and yield is not just about dividend yield, but it's also about share buybacks, which was mentioned before. So it's about total shareholder yield. Now, this is the slide I really want to show you because this is the proof in the pudding. I mean, all this academic stuff, what does it deliver you? And does it deliver something, some actual value add? For years, I mean, this is the basis of what hedge funds were doing. They were charging people 2 and 20 and using these screens and charging you those astronomical rates. But now with the magic of ETFs, you can get them for 25 basis points for the USA exposure and 28 basis points, so 0.28% for these exposures. Now, just very quickly to say, just to understand this, so these are these different factor tilts over since 2009. There's the parent index. These are the 4 different factor tilts, and the you can see the returns that they've delivered with lower levels of risk. This volatility is risk. So you can see there's, up here, this is a slightly long time period, since 2009. It's not quite as clear, with that one, or as prime value because you've got a bit more risk. But again, we don't have time to go through this entirely, but I think it's an important thing to impress upon that this is a long-term investment approach. This is not something that over a 3-month or 1-year period is going to necessarily outperform the parent. But if you have a long-term investment horizon, alternative beta is something that you could seriously consider if you're willing to take the waves of the market and how it goes. Now, I'll quickly show you this last slide. If there was something of all my slides as close to a free lunch, you could argue, well, combining all 4 of these factors, again, here's the performance of the parent index per annum since that time. This is if you throw all 4 of these into a blender and play them out quarter weighted. You've got better performance and lower risk in each case. Eurozone is the same as well. You can combine the cyclical and defensive as well. But again, we don't have time to deal with that now, but we could pick that up in the questions. So that was it from my side. We as an ETF provider, as I mentioned, we are 4th largest in Europe. We offer exposures to all these things I've spoken about today, as well as a number of other core exposures. But on that note, only 1 minute over time, and I'll call it a day there.